Hi, everyone. Good morning, good afternoon, good evening. Thank you so much for joining us for this internal briefing on lessons on new financial technology for unbanked consumers. As we all know, the events of this past year have been extremely challenging for everyone, but particularly for those around the world without a financial safety net. And unfortunately, the pandemic is estimated to push as many as 150 million people into extreme poverty this year. In addition, we've seen a massive spike in digital adoption globally, which may in large part be a trend that continues well beyond the pandemic. And while this could lead to more opportunity and inclusion for the and underbanked, we also know that new consumers can be at greater risk of predatory financial products. And so I cannot think of a more important conversation, particularly for folks at Mastercard, focused on our company-wide commitment to bring 1 billion people into the global digital economy, than one on the role of financial technology adoption for increasing financial security for new consumers, and what new insights we're learning from experts in the field. And so we are very privileged to be joined today by two eminent friends at the Center for Inclusive Growth who are leading research in the field. Dr. Leora Klapper, who's a lead economist at the World Bank for the Finance and Private Sector Research Team. Leora is also the founder of the global Findex database. I think I can speak for many individuals on the call when I say we are all on the edge of our seats awaiting the 2022 results of the Findex. And Leora is also a data fellow for the center. We're also joined by Professor Jonathan Morduch, Professor of Public Policy and Economics at NYU, and the Executive Director of the Financial Access Initiative at NYU, which houses the center's financial security insight community. Jonathan is the author of the highly acclaimed US Financial Diaries. And Leora and Jonathan have kindly accepted our invitation to share some insights from recent papers they've published that touch on financial technology adoption for new consumers. So we'll first hear from Leora on her new paper, Learning to Navigate New Financial Technology, Evidence from Payroll Accounts, as well as several other related studies. And then Jonathan on his research on poverty and migration in the digital age, experimental evidence on mobile banking in Bangladesh. I'll then pose a few questions to kick us off, and we will open to Q&A via the chat. Throughout the session, you should all feel free to submit questions via the chat as they come up, and we'll draw from them later. So with that, I will pass to Leora to set the stage a bit further and share some of her insights.
Thank you. Thanks for the introduction. And thank you for the invitation to join you today. Can you see my slides?
Yes, we can.
Okay. So I work at the intersection of research, data, and policy. And most of my ongoing academic research focuses on the impact of digital payments, especially for women. So I'll discuss with you today both some of my own research and others. And there's a growing number of studies on what could be thought of as the first generation of financial inclusion research. The impact of account ownership on household welfare, including higher savings, greater spending on education, nutritious food, better jobs, safer, less expensive remittance payments, which Jonathan's going to talk about, an increase in financial resilience, the reduction in poverty, which has been incredibly important in driving evidence-based policies to expand access to digital financial products, including cards and mobile money accounts, and to encourage governments to shift to digital payments, to social transfer payments, pensions, and their wages. These rigorous research papers have very effectively motivated policymakers, banks, fintechs, mobile money, account ownership at the individual level, meaning it's not enough for the male household head to have an account, the importance for younger adults, women, and other people in the household to have their own accounts. A subset of this literature shows the benefits to going digital. For example, that switching Social Security payments in India from cash to digital saved millions of dollars. The recipients got more money because less was being stolen. There's also evidence, for example, in South Africa, that women increased their labor force participation and financial control when they took up digital payments of safety net benefits. A study I always quote of the Kansas cities in the US shows that in Missouri and surrounding areas, burglary, theft, and larceny dropped when safety net payments were digitized. And in Malawi, farmers who had their earnings deposited into a savings account had higher savings before the next planting season. spent more on agricultural equipment. Consider this discussion in the context of COVID, as physical distancing became necessary, cash became unsanitary, and traveling to make and receive payments became a health risk. Governments used digital payment platforms to quickly disperse stimulus funds. Like in Togo, the Visi cash transfer program made payments to mobile phones of about 20% of all adults. And formal workers in Morocco, which is a hard to reach market segment, received government help through their phones. There's also a surge in Asian digital salary disbursements. For example, according to the Bank of Bangladesh, salary disbursements as a share of total mobile money increased from 3.7% in April 2020 to 7.3% in July 2020. And there were challenges. For example, a recent study is showing that in Colombia, mobile COVID-19 relief payments suffered from poor product design and weak digital connectivity. Digital users were 2 times more likely than cash users to complain of difficulties and delays. In Africa and Asia, this is a map from the GSM Association, digital payments has been driven by mobile money. According to the GSMA, about 300 million mobile money accounts are being actively and globally used every month, an increase over 100 million from September 2018. But most of this activity is person-to-person payments. And most payments from the government, employees, or family is immediately cashed out. On the bottom right, you can see that only about 4% of transactions were merchant payments. Most of this activity is person-to-person. And most of the payments from the government, employees, and family are, as I mentioned, are cashed out. And so I'm going to focus on what might be thought of as the next generation of research, studying how to leverage the use of accounts to receive payments and to encourage recipients to keep their money digital and use additional financial services in order to improve their lives. And so let me focus on some specific use cases, starting with digital wage payments, which is rapidly being adopted by global value chains, especially in the garment sector. For the factory owners, digital payroll is cheaper, safer, and quicker, and global buyers are demanding this electronic trail of fair wages. We found in Bangladesh that factories save about 750 hours per month in lost production time when they digitize wages, mostly from workers not standing in line, from managers not doling out the cash. In a new working paper with Emily Briza and Martin Kahns, we study how workers with limited financial experience learn to use a new financial technology. We ran a randomized control trial with 3 treatment groups: a control group who continued to get paid in cash, a group who got paid a group who simply got a bank or mobile money account, and a group who received an account plus digital payroll. We show that paying wages to factory workers in Bangladesh into a payroll account gradually leads to an increased account use and greater financial capability, as compared to the workers who only received an account, but not digital wage payments. Workers receiving electronic wage payments show increased savings. This mostly came out of a drop in spending on impulse purchases, like snacks and soda, and improvements in the ability to cope with financial emergencies. For example, workers were less likely to report skipping meals at the end of the month. We also, workers paid into a mobile money account are also more likely to send remittances home themselves without the help of an agent. And this is a recent photo we got of the workers receiving their payments during COVID. We also, and so just in terms of the transaction without assistance, so we were able to show both that workers had the confidence. So we always had, part of the learning by doing was having a bank agent on site on payday, supporting the workers with their transactions. We found that these workers very quickly were able to start making transactions themselves at ATM machines in the city without assistance. And here again, that they were able to send remittances by themselves from their own phone without the support of an agent. We also did a mystery shopper study where we sent actors posing as garment workers to mobile agents to make a remittance payment. We found that agents operating around the factories that pay electronic wages are less likely to take advantage of their workers, such as adding on extra fees. This suggests first that workers paid digital wages become savvier financial customers, and second, that there are potential spillover effects to the communities. New work is underway in collaboration with the IFC, studying optimal product and delivery design for digital products to garment workers in Cambodia, as well as to tea pluckers in Sri Lanka and agribusiness chains in Ethiopia. And I'll briefly mention some potential benefits to digitizing agribusiness supply chains. There are huge opportunities, both in sizes, the number of farmers selling to global value chains, as well as the benefits to the workers. So the farmers, who they only get paid twice a month, the The farmers may only get paid twice a year. They need to stretch that money to pay for daily food, monthly school fees, and seeds and fertilizer for the next harvest. Digitizing their payments could be their first entry into the formal financial system, and access to additional appropriate financial products, such as input financing and index-based weather insurance. For instance, randomized control trial studies in Ethiopia find that increasing the uptake of insurance against weather shocks can improve the yields and lift farmers out of poverty. In addition, new digital products are tracking both the quantity and the quality of agricultural sales. A challenge in this sector is traceability. For example, if all coffee beans are dumped together, no one farmer has incentive to invest in higher quality organic fair trade seeds. Traceability allows farmers to receive a higher price for higher quality or organic fair trade output and potentially secure advanced financing. My colleagues are running a randomized controlled trial in Burkina Faso, studying the impact of digitization payments and traceability in the shea butter sector, which is mostly grown by women farmers, to say the impact of these women's control over their resources. Real-time information can also be leveraged by new fintech applications to improve financial health, which have targeted underbanked workers and independent contractors who, like farmers, have lumpy income. Financial products could help smooth their income over time and avoid expensive money lenders. For example, farmers can receive immediate access to their payments instead of waiting until after the next auction, which might help farmers better manage expenses and handle emergencies. And so finally, I took this photo of a woman in Cote d'Ivoire who worked at a call center and was paid into her account, but immediately cashed out her wages and transacted only in cash, except for some money she loaded onto her mobile phone to send money to friends. So how do we encourage her to keep her money digital? If we have time, I'm glad to talk about ways digital financial services have been integrated into a wide range of services, such as solar energy and clean drinking water, tuition payments, and transportation. Let me focus on one payment closest to your hearts, that during COVID-19, there's been a surge in digital in-store payments. In some new data I collected in 2020, about 20% of adults in Latin America made a digital in-store payment for the first time during COVID-19. Yet about half of all adults who reported making a digital in-store payment for the first time during COVID said they want to go back to using cash. So an additional challenge and research question is how to keep customers gained during the pandemic. And this is hard. It requires merchants who are willing to make their sales more transparent, pay the transaction costs to accept digital payments, and customers who must be comfortable with the technology and the mental accounting. Now, something I've been thinking about, for example, an actual experiment in India, study the 2016 demonetization, I found that customers that shop online and pay digitally as compared to cash on delivery spend more and are less likely to return their purchases. In a 2000 study, and with the caveat that this was a lab experiment of first-year MBA students at MIT, researchers found that customers are willing to pay up to double when they pay digitally using a credit card instead of in cash. Intriguingly, 20 years later, the authors did a follow-up study to understand why, and used MRIs and brain scans to show that digital payments increase the pleasure of purchasing. So raising lots of interesting questions how mobile money payments can influence consumer habits and make them happier. And so I'd like to end on the critical question of trust, which is key to the success of any digital financial product. So trust in fintechs to keep your balances and savings safe, trust that your employer can't take away your money from your payroll account if you leave your job, trust that connectivity problems will interrupt a customer's payment and prevent you from losing a sale, and trust that you are being offered fair credit terms. Ultimately, understanding how governments, banks, and fintechs can build trust with their customers is a fundamental research question we need to answer to encourage the greater use of digital payments. So thank you.
Thank you so much, Leora. You covered a lot of ground, already have a lot of questions, really interested in how we can think about trust and technological adoption. But before we dive into the discussion, I want to pass off to Jonathan to talk a little bit about his study on mobile money and remittances, which we think is really complementary, a different type of technology, but some similar lessons we can discuss. So over to you, Jonathan.
Thanks, Ali. It's really nice to be here. And it's really great to follow Leora. Leora's work is just mapping so many important questions, the Findex, but then these broader studies. And what I want to do in following Leora is to hone in on one particular set of connections where technology really matters. And that is with technology as a part of migration decisions and sort of the migration economy. So I'm going to share a few slides here. Although I do not see them here. Let me get them going. Just one moment. Let's see if I can pull these up quickly. I want to talk about a study called Poverty and Migration in the Digital Age, which has been completed with a wide group of colleagues, some of whom are now at the World Bank and who've been focusing on Asia for a long time. And I'm going to follow Leora by focusing part of these comments, or she focused partly on Bangladesh, and I'm going to focus exclusively on Bangladesh, but hopefully we'll be able to talk later about some other places. But I wanted to start with an observation that's been really powerful for people who are thinking about how can we make the world a better place, a less unequal place, a place with more opportunities. And that is work that's on international migration. And I think about work by Michael Clements, who's at the Center for Global Development in Washington. And Michael has this very powerful observation that if you think about migrants from Haiti who come to the United States, there are about 1 million Haitians who are living outside of Haiti, many in the United States, some in France, other countries. But Michael's first observation is that, as many of you know, someone with low skills moving from Haiti to the US earns 6 times more money in the US. It's a very, very powerful way to increase earning ability. And then the payment side comes in with remittances. Haitians abroad send home about $1.5 to $1.8 billion per year, which is much bigger than the total amount of foreign aid that Haiti receives. And it's about 1/4 of Haiti's GDP. So what the work on international migration and remittances shows us is that the quantities and the changes and the transformations are really substantially big, and that the payments infrastructure, the remittance possibilities, are what makes it all work. So that poses a lot of questions for thinking about policy and thinking about immigration policy, as we all are, especially in the United States. But it also raises questions about how this works in other settings. And what I want to talk about today is domestic migration. So we think a lot about international migration because, it's so big in the news and touches, so many of us and really creates these transformations. But there are similar kinds of transformations that happen when people move from their village to a major city or an economic hub within a country without even leaving the borders of a given country. And this is happening increasingly. And we see this in part through data on urbanization. This is a quick picture of the changes in urban and rural populations globally. And it used to be, if you go back to 1960, that most of the planet was really rural, poor and rural in most developing economies. But that has radically shifted. And in this century, the urban population is now bigger. Part of that is just growth within the urban population, but part of it is a steady flow of migrants. And that's where payment infrastructure can really, really be critical in transforming that movement of people into a parallel movement of money. And that can have transformative possibilities for poverty and inequality. So we've been doing some work in Bangladesh, really in 2 sites. One is in Dhaka, the capital city. And Dhaka has been growing really fast in economic terms, both in population terms and economic terms. Meanwhile, much of the country has been emptying out. And one of the most vulnerable places, poorest places, is a region up in the northwest called Rangpur. And we've been focusing on an area called Gaibandha district, which is one of the poorest regions in this very poor area. It's a region where people don't always have enough resources to be able to eat 3 meals a day. There's a lean season called the manga season, or seasonal famine. And one of the things I want to show you is research which allows people in Gaibandha to benefit from these flows, to benefit from the migration to Dhaka, and through that, to be able to have an easier time during these lean seasons. The idea that migrants from a place like Rangpur could go to Dhaka and then send money back home to their families is not a new idea. In fact, in Kenya, when M-Pesa started, the mobile money platform that really created this revolution, their first advertising campaign was simply send money home. M-Pesa, send money home. And you can see with Bcash, this is a Bcash ad. Bcash is the M-Pesa of Bangladesh. It's the biggest mobile platform by far, mobile money platform. And this is an ad, a factory worker suggesting that Bcash can be a very powerful way to send money home, safe and convenient, and reaches home instantly. So we have a very powerful idea, and digital money is really at the heart of it, where you're sending remittances back up to Gaibandha, that red district in the northwest of the map, while workers go south. And so we wanted to know whether facilitating that financial relationship through Bcash would make a difference in people's lives. Could the very poor people who were not using Bcash, who were not using digital money up in Gaibandha, could they be introduced to it? Would they use it? Would they be reliable customers? Would they be active customers? And how would it change their lives, if at all? So that's really the study. The families we got to know in rural Gaibandha, which were not using digital money before we began the study, they all had a family member in the city. So there was a clear potential market for digital money here. Almost all of them had mobile phones. So again, they've got the pieces in place, and very few of them have bank accounts. Only 11% of them had bank accounts. So again, there is a gap here that potentially mobile money could play by becoming that banking substitute. Bcash provides mobile wallets and other banking services without your having to go to the bank. But again, this is a very poor population and a not very well-educated population. And that raised a question as to really how big this market would be. 22% of the families that we surveyed were using mobile money, but that left 78%, which were not, but which could. So what we did is try to think about the pain points, try to understand why people were not using mobile money, even though it created this possibility of receiving remittances more easily from the family members who had migrated to the factories. So the first thing is network externalities. If it's no use signing up for a platform if your family member who's a migrant doesn't have that platform, right? Everyone has to be on the platform, and the migrant has the same thing. They don't want to sign up for this service if their family back home doesn't have a chance to sign up for it or doesn't know how to. And so that becomes a big issue, why a lot of people don't sign up. They see the possibility, but everybody has to do it in a coordinated way. Signing up is also a pain. It's you have to put documents together. You have to figure out how to do it. There are forms. Those forms are written, and with a less educated population, it's hard. So that's a burden. And this population has limited English. Now, that matters because the platform, the telephones, have English language menus, which makes this really intimidating and impossible to use for a lot of people. So what did we do? Well, we set out a protocol to market both to the families in Gaibandha, in the rural area, and to the workers in Dhaka. We helped collect documents and connect people to agents, and we translated everything, and most important, gave folks hands-on training with the technology so they could send money back and forth, just try it out themselves before they signed up. That turned out to make a big difference. And we did this in 30 to 45-minute sessions, left them with the translations and helped them with enrollment. It cost about $12 per family for both sides, which was pretty small relative to other interventions. And here's what happened. We went from 22% up to 70% just thanks to that intervention. So we did see that there was a lot of interest in this, but people were getting stuck with these hurdles. And once we removed those hurdles, demand went way up. When we talked to the head of Bcash, he was really surprised. He didn't imagine that this population was even worth engaging with because he thought they just weren't interested. It turns out they were interested, and they did become active users and reliable users. They just had been ignored because people were making assumptions about them. That increase in usage then translated to an increase in remittances. Remittances from the factory workers in Dhaka back to their families in Gaibandha went up by about a quarter. And those remittances, that increase, led to a substantial increase in the well-being of the families back in the rural areas. Extreme poverty fell, consumption went up. There were fewer problems during the lean season. There was more self-employment and more resources to send more migrants, which itself then reinforced this pattern and brought more resources back to the countryside. In the urban area, the migrants were working hard. They're now sending more remittances back. They were saving a little bit more. They tended to be more informal employment. Poverty went down a little bit. But the big story that we took away was this was really adding a burden to them. The technology was disrupting their lives. It was allowing them to more easily send money home, which was a great benefit. But it also meant that there was more pressure to send money home. And when we asked about their physical health, their emotional health, we saw consistently that they reported that that was becoming harder. And so when we think about technology, it's not entering into a situation neutrally. It often has these social ramifications. And here there were some very, very clear benefits and some clear costs. So just to pull this together, the study demonstrated to us that poor households want to use, can use digital financial services, and they can get big impacts from them, but there are clear hurdles. And those hurdles include network externalities, the problems of sign up, and language barriers. We also see that technology can disrupt relationships for better and worse, and we need to think about those as we design products. And the final thought, which is the big thought, is that we usually think about solving problems, big problems like poverty, by trying to bring more resources into an area to increase the earning power of local residents. And that's the idea behind microfinance and other interventions. What these new technologies do, right? Payments technologies, other technologies which can move money across space, is that they can bring radically different perspectives on big social problems. Domestic migration, moving people to places where they can earn a lot more, then can become part of a broad poverty and inequality reduction strategy, as long as it's coupled with technologies which also bring money back home. So those are some thoughts. I look forward to talking more, and I will turn it back to Ali.
Thank you so much, Jonathan. So interesting. So many insights to unpack with both of you now. So now we'll start the Q&A portion, which we've left ample time for. I'd encourage our participants to put questions in the chat or the Q&A, and we'll get to them. But I will start with just some high-level questions that I think apply to both the research presentations you shared, which are very very all-encompassing. So let's see. So you've both shared interesting insights on how financial technology can impact new consumers, payroll, mobile money, and beyond. Of course, we know the goalposts have shifted in the past year due to COVID. And you've touched on this already. You've mentioned mobile money and card use is on the rise. But just to put a bit of a finer point on it, what lessons from your studies do you think are most important to take forward for supporting new consumers in this new post-COVID world? And just a couple follow-ons, how will the era of COVID impact low-income households and their adoption of technology? And really, what trends do you think are going to stick around in the long term versus, in the short term as a result of things being shut down? So I can give that to either of you. Does one of you want to start?
excuse me, I'm happy to start.
Great.
So I'm optimistic, both that hopefully the world will recover soon, and that this new adoption of digital payments during COVID really presents big opportunities. The lesson from our study is clearly that classroom financial education we know isn't very effective. It might allow you to answer questions on a quiz better, but it doesn't change behavior. To change behavior, and this is something we've known for a long time from the behavioral literature, requires that hands-on experience of using financial transactions. Everything from just the comfort level and the confidence in using them, to there's a nice study in Mexico showing that people use their ATM card just to check their balance, to build up their confidence that their money was safe in the bank before they started saving larger amounts. And it's interesting, in our study and work in Mexico, Afghanistan, it's almost around this magic 6-month mark. Now, for about 6 months, people pretty much withdraw their money, but they use it every month, right? And then around 6 months, they build up that confidence. We start seeing the savings and the balances, increase over time. And as I mentioned, there's been a surge in digital payments of wages, for example. It simply became less safe to stand online, but also transportation. For example, in Kenya, the matatu buses, which are used by about 70% of the population, became unsafe to stand in line. Last fall, they rolled out a fare collection platform. There was initial resistance, but there's an article that now this comfort level is something that will stay. There's a stickiness to that kind of payment, and so simply there are opportunities now of encouraging greater adoption of financial services by people who during COVID might become more comfortable with the technology.
Great to hear. Thanks.
Yeah, I definitely want to follow on that. COVID has pushed governments and private providers to use digital platforms much more. We see governments wanting to provide benefits digitally because they can't engage with people directly. We see microfinance institutions going digital. We see just digital happening at a much faster rate because of COVID and the need to social distance. So it's been very powerful that way. And I think that will play out, as we move forward. The COVID situation was unusual in that the whole country and the whole world was affected by this pandemic. It was a pandemic. And in that sense, I think what gives me room for optimism is that in the future we'll have this technology, but we won't, we hope, have this kind of all-encompassing challenge. I think what digital has been so powerful in providing is the opportunity for spatial diversification, that someone in the city can send money to someone in the villages and they won't be both suffering difficulties at the same time. So the people in the city don't have a lean season in the same way that people in the village do. So they have resources to share. That is new and different and powerful, and will continue. The challenge with COVID was that it was very unusual that everyone was struggling at the same time, and that didn't work so well. I think as we look to the future, we're going to see a lot more of that kind of risk sharing through mobile platforms.
That's interesting. That's a really interesting point. And another point around COVID is, and something my colleagues and I have been thinking a lot about, is the whole loan approval mechanism. So historically, the risk of default was based on previous firm performance, previous firm historical information on loan performance, on firm performance. But if the risk to the loan repayment is whether there's going to be a lockdown and shutdown in 2 weeks, that historical information is less useful. And increasingly, what we're seeing is new emerging models where credit's being granted based on the real-time information, based on open table reservations, based on your digital payment purchasing today, your inventory purchases today. And this real-time information economic activity, I think, will become even more important and continue to be important for some time.
Thank you. And while we're on the topic of loans and perhaps the impacts for small businesses, I'll also mention for those of you on this call, we have another event on Thursday with Axion talking about helping entrepreneurs go digital and driving inclusive recovery through digital transformation. Highly relevant to this conversation. And we'll we'll have Shamina speaking and the CEO of Axion. So perhaps someone from the center can post that link. But thank you for those thoughts. They're really, really interesting and useful reflections for us. I'll come back to some of my questions, of which there are many, and switch perhaps to some coming in from the audience. And we'll start with one from Sue Kelsey, who's our global head of global product and financial inclusion. Sue asks, I've read that financial literacy training, particularly for women, trickles down to their children. So literacy transcends across generations. However, I haven't seen any quantitative data around this. Do you agree that women pass on their knowledge? And if so, do you have any data points? I'll pass that to whomever has some thoughts on it.
I haven't seen data on that, but it totally makes sense that would be true, that there would be an intergenerational benefit, because that's how we all learned, I think, from our parents at some level, even just watching them. So Sue, it's a really interesting question. I think that the question that comes up for a lot of us who are thinking about product design is what you can do with that kind of basic financial literacy. Once the kids have that, say, it certainly makes it a lot easier. But I think what both Leora and I see in our work is that financial literacy in that traditional sense, just understanding about savings and budgeting, isn't enough. That with the new technologies, you really need to understand, how they work, get some hands-on experience. I think both Leora and I have seen that. And so it's a different kind of education that's needed to introduce these new technologies. And for us, that was a real barrier to people who really wanted to use these technologies, and they just couldn't get their minds around it or their hands around it.
Yeah, I'll also add, I always think back to a wonderful study done long ago in New York, where they introduced student bank accounts to students at a low-income New York City public high school. And the interesting impact was on the parents' savings rates. So not only did the children start saving, but they sort of brought it home and taught their parents. And especially since what we're talking about is use of technology, which we know that younger generations are more comfortable using the technology. I suggest there might be also some interesting spillovers between the children and their parents in that direction.
Yeah, really interesting. We also have a question from Luz Gomez, who heads up the Latin America programs at the center. Luz asks, who should pay for training for the more vulnerable who may need more hand-holding for onboarding? Is it the financial service provider, the value chain businesses, philanthropy? Do either of you have any perspectives on that? I know training's been a pretty significant component in the effectiveness of both your studies.
That is a tough one. Our training cost $12 per family. And for the benefits we saw, it was really worth it. But those benefits are going to the families. They're not going to the business. And that it is a real question. When we do the cost benefit analyses, it is not worth it for Bcash on their own to shoulder those costs in a simple business way. So I appreciate that question, Luz. I think it may have to be, other actors, perhaps, providing, a demonstration model, and then it's possible that families themselves may be willing to pay some for it, and have some kind of user fee model.
I agree with Jonathan. And also when we talk about government transfer payments, we've seen examples where recipients don't even know the basics, for example, keep their PIN number private, recourse in the case of mechanical human error. Although I would say, when we're talking about, for example, wage salaries, we're seeing, whiffs of suggestive evidence that it improves, but we certainly find in our study that improves worker satisfaction with their job, for example. And we know that, eventually can result in higher productivity, in which case it would be to the employer's benefit to encourage greater use of the accounts. For example, workers who are more financially stable are less likely to take sick leave. We know that. We're trying to work, for example, the work I mentioned with tea pluckers in Sri Lanka, there, and it's just real interesting fintech support where The women pluck the tea, which is weighted by Bluetooth-enabled scales multiple times a day. And there we really hope to draw a direct relationship between digital wages, use of accounts, and greater productivity. So there is potentially a business case for the employer investing in this education, as well as, with the ultimate goal of the workers using their accounts more, certainly financial service providers, if they think there's a business case for a payoff of that support they provide to workers.
Yeah, that's interesting. It's a tough one. While we're talking about training and costs, I also wanted to dive a little deeper into the intersection of technological adoption and training. It's a topic that comes up a lot at the center, how to do effective training for tech and touch. And Leora, in your payroll account study, you placed emphasis on learning by doing as an effective way to increase transaction activity and reduce consumer protection risks. I'll ask a question to you and to Jonathan, but they're related. Can you talk about the difference between this and other training approaches and what the audience should take away from this approach for other tech adoption development programs? And then to Jonathan, what did you learn about the hands-on training approach in your study? And can you help us understand the difference, if any, between training oriented around a product versus what we traditionally call financial education?
Sure. Just to describe our intervention, we provided very basic classroom training and just on the payroll account, how to keep the number private, et cetera. But then we worked with the bank so that there was a staff on site at the factory on payroll, on the day of payroll for the first, at least it was 6 months, and helping each worker withdraw the money from their account. We also, which was quite important, arranged with Bcash to have an agent, a mobile money agent on site on payday to help with cash withdrawals. This was important both to ensure that there weren't going to be additional fees tacked on potentially by agents in the city. There's also challenges in Bangladesh, which is that in order to activate your mobile money account, you need to give your phone number to the agent. And women in Bangladesh are often uncomfortable giving their phone number to strange men. And so many women reported not being as comfortable using agents in the city, at least initially, and so use the agents on site to cash out or for support making remittance transactions. So that it was that ongoing support which really built their confidence and capability to then use the product on their own.
Yeah, that's really interesting. I want to talk a little bit about agents too. The way that mobile money works is you have a network of agents across the country, and they're close to the factories. The factories are sort of surrounded by agents, and then in the villages there are agents as well. And they continue to be useful, even in our situation where we weren't engaging with the agents, but they were just there and they knew what was going on. And we found that the households would often go to the agents for help, and the agents were often a part of doing this, even though in principle they don't have to be really so much a part of this equation. But as Leora is saying, it does then create these social tensions. And that really needs to be thought through better. How can the engagements with the agents be more neutral, be more respectful, and be more protective of populations that are vulnerable and women? Just on the training, the hands-on nature of it, not just, we talk about product training, but that can just be like describing a product. I can tell you everything about a product. It's totally different when you get it in your hand. And we made sure that everybody who was in our training could send a transfer back and forth at least 5 times before they left the training. And that made a difference, not just once, not just twice, but 5 times. And then they really, had it by then. And so it's not just product training, but the right kind of product training.
Yeah, thanks. That's really interesting. And it sounds like in both cases, the actual use of the product with someone who understands how to use it is absolutely critical, as opposed to some sort of textbook or more traditional classroom setting. So really interesting to see what works for both your research projects. Okay, now switching over to a question from Emma Stanton, who heads up our India flagship program at the center. Leora, you said that you saw a huge acceleration of mobile money and digital payments, but in 2020, but most will cash out. So Emma asks, in Bangladesh, did your study cover long-term stickiness of digital behaviors? Did you see cash out behaviors upon receipt of payroll into the digital payment account? Or were workers leveraging digital payments for other transactions like groceries, rent, et cetera? And was the acceptance ecosystem robust enough to support this?
So if I can share my screen for a second, I have a PowerPoint on hand. Do you see it now?
Yes.
So I just wanted to highlight, I think this is really important context. This is a pie chart that we did in our baseline survey of our workers in our studies. This is before they had accounts or electronic payroll. And this is something I really want to get at. How is your money spent the day after you receive it? So within 2 days, or 5 days in this case. And what this is showing is, first of all, a quarter of their salary is going to rent, 35% is being sent home to family. That's huge. And you have loan repayments, that's both microfinance, but it's also mostly all the food is bought on credit, repaying their food bills, as well as, school fees, a large portion of their salary as well. So that brown piece, that 25%, that's all that they have to get through the entire month, plus savings. So first of all, just understanding just how financially constrained these workers are. And I would argue that there's so much work being done on commitment savings and long-term savings for these workers. What they really need help is just getting through that month, getting to the end of the month without skipping meals or going hungry. And then I show you one more. So this is the figure from our paper. On the left-hand side, it's direct transactions. So these are workers who send remittance payments on their own. And so the ones who have both mobile account and the electronic payroll, that's 62% send it on their own, as compared to 20% of those who only have an account but aren't receiving electronic payroll. You see how it's flipped in terms of indirect transactions. 65% of workers without electronic payroll are making sending remittances using an agent, as opposed to only 33%. And so the result, that as the previous figure showed, the demand for domestic remittance services is huge. And secondly, it really is a very significant impact. Thanks.
Thanks. That's great. That's really informative. Jonathan, do you have anything to add on that, or I can move to the next question?
Yeah, why don't we move forward?
Okay.
This is great.
Great. Next question is from Philip Perry in the Enterprise Partnerships team. Philip asks, I think it's directed for Leora. We often hear the concern that digital salaries are just converted into cash at the next ATM. Do you have any insight on the percentage of this and the conditions that need to be fulfilled to allow recipients to fully benefit from digital finance? So I think we've addressed that, but anything else you want to add? What, did we lose Leora? May have.
I think we may have. I think that what Leora just put up with just how much money gets spent so quickly is a really important part of the picture here. Mm-hmm. It's not just that it's hard to, at this point, use digital to go to the grocery store because those connections aren't there. It's that also the nature of people's finances are that there's relatively little slack in budgeting. And so there's a sort of longer term transformation that's going to happen, building up slack coupled with these new technological possibilities.
Yeah, thanks, Jonathan. Looks like Leora dropped temporarily, but we're in good hands with Jonathan. So Jonathan, I'll turn another question to you, which is, we've learned some really important lessons from you all. How do we ensure, based on your work, that financial technology solutions are really benefiting low-income consumers? And what are the limitations or concerns that are important to keep in mind to ensure that those benefits are there with these technological solutions?
Yeah, it's a great question, and it's a hard question. I think the first one is to continually challenge our assumptions, because it's easy to see people using a technology and say, oh, this must be just great. It's making things easier. In Bangladesh, we saw that, without mobile money, people were spending, if they wanted to send like $50, it could cost, $12, $13 to move that 50, which is a lot when you don't have a lot of slack. And digital reduced that to about $1, from about $13 to about $1. I mean, incredible reduction in costs. And you think, well, that's all gravy. That's all great. And yet when we did our study and tested our assumptions and really spent time getting to know what, how people were doing, how the migrants were doing, we saw that what seemed like an unmitigated positive thing was in fact a real challenge for the migrants. And you just saw Leora's great pie chart there with how much money is moving.
Yeah.
And add to that, the pressure that now with this great technology that we love because it's so instantaneous and safe and secure, but it also adds a lot of pressure because now your family can call you up and say, hey, we need some money. Your father or mother's not doing well, your siblings. And so the only way to really do that is to get to know customers and keep, a finger on the pulse of what customers are doing. And that can happen through focus groups or surveys, but there is no substitute for really getting to know your customers.
Yeah. Thank you for that. And then I know, Jonathan, your study in particular covered remittances. They're intra-country remittances. But I know this group is really interested in learning a little bit more about cross-border as well, and maybe whether there might be lessons there. So we've seen initial evidence that cross-border remittances did not fall to the levels that we would have expected as a result of COVID-19. To what extent do you think the lessons from this study can be applied to cross-border?
Yeah, I mean, absolutely. After COVID-19, we're going to go back, I hope, to a more normal situation. And these same mechanisms, I think, really will play out, that seeing migration and digital remittances as a key development intervention, inequality fighting intervention, I think we're going to embrace that much, much more. I mean, people like Michael Clemens have been arguing this for decades. I think the part that's less understood is the domestic part, but even the international part, I think, is less well appreciated than it ought to be. Yeah.
Thanks for that. And sadly, this has flown for me, but we're getting close to the top of the half hour. So I wanted to ask, one final question to our panelists, and hopefully we'll get Leora back. She's in and out.
Yeah, she may be back.
She's there. But I'll start with you, Jonathan. We are, in awe of your research and so thrilled to be partnering with you all. What's next? What are some of the new research questions you have underway on this topic? And, sort of what should we have in our minds on the horizon for new research and what we need to answer next?
Yeah, there's so many pieces, and I've got to say it's really exciting to be able to engage with you and with Leora, because there's just hearing about the new projects is always interesting. On our side, we are taking our study and we are looking with your support and the support of the Gates Foundation at how this plays out in other places. So we're working in Pakistan, we're working in India, we're working in other places in Bangladesh to see how it works out. And already we're seeing in India, there's a lot of competition for mobile, digital payments coming from the traditional banking system. One of the great things in India is so many people have banks. In our data, maybe 11%, had a bank account to begin with. In India, that number is closer to 80%. I take that from Leora's research, and people are using the banks, transferring money within a bank to move money from one place to another place. And so it'll be interesting to see whether this has the same kind of impacts. But the other thing we're doing, and again with your support, is something we call small firm diaries. We're really interested in how small firms are using digital or could use digital. They don't tend to be very digitized in terms of using this infrastructure. It's interesting, the owners of a small firm may use digital money in their own lives personally, but it doesn't get used in their firms. And so we're going to be spending time with small firms, globally in Sub-Saharan Africa, Indonesia, Latin America, to try to understand how digital money has potential in their businesses.
Come here if you. Hi, I apologize. There's a storm yesterday and my internet's been unstable. So in terms of new research, as I mentioned, you were quite interested in understanding the impact of digital payments on productivity in agribusiness chains. We're also looking in Cambodia, which has the highest MFI rates of use rates in the world. So this interaction between digital payroll and credit, both the use of credit, credit repayment effectiveness, and also really interested in various use cases. For example, on tuition payments, Mastercard, for example, has a tremendous program. There's a seminal paper in Kenya showing that when people have mobile money, they're able to get support from a greater both geographic and social network of friends. And so when you think about digitizing tuition payments, do we find, for example, that when a family's in trouble, they're able to reach out to more people to keep their daughter in school? Or, for example, do we find that a brother living in the city is more likely to pay for his niece's tuition directly to the school than make the payment to his brother who can divert the funding? And so, looking more carefully at both patterns of tuition payments that are made electronically and how it could build resilience to keep people in school is, I think, a really important underlying question.
Wow. Well, I am so excited for all of the research coming out, thrilled that we've been able to support and partner in a lot of it, and looking forward to these insights as they come out. We're so grateful that you both took the time to speak with us and this group. I know this group is really, really interested in the work you all are doing. I also want to thank the robust team behind the scenes helping to make this seamless and this has taken a lot of prep. So really grateful to the folks at the center and to our great engagement from Q&A. And thank you so much, and looking forward to all that is to come. We hope everyone has a great rest of the day. We'll follow. This has been recorded. We will follow up with the recording and share it with anyone else who's interested in inside Mastercard, and hope this is one of many conversations we have to help everybody improve their engagement with new consumers and tech adoption. So with that, have a wonderful day.
Thank you.
Thank you.
Thank you.